Good afternoon, everyone. I'm Michelle Nofel, Head of Distribution. I'd like to welcome you all to our quarterly webinar for City Different Investments. Thank you all for joining us today. We're going to kick off first with our fixed income team. Chris, 2024 started off strong, but hotter than expected inflation readings have tossed some cold water onto both the equity and fixed income markets. Both markets were taking comfort at the end of the year with expectations of 6 to 7 quarter point Fed cuts, only to see that fade away. What are your thoughts?
Well, as you said, Michelle, the market did get ahead of itself going into ending the fourth quarter. And what's happened is the economy looks much stronger than people anticipated, and hope dies hard. So we've seen rates increase a tremendous amount in the first quarter and even more through April. Now that's a mixed bag because the economy's doing well. You know, we take a long-term view of the economy looking over 20-year trends. And based on GDP, it looks good. Unemployment's low. There are 8 million jobs open, so it's like 1.4 jobs for every job seeker. March unit labor cost, little high, and that's a bit concerning. And productivity is a little low, so that was a bit concerning. But nothing outside of a fair range as we look at it. And with the increase in interest rates, it made bonds very attractive. And one of the reasons is because this is the first time in a long time that investors are getting paid to own bonds, especially in the treasury market. Municipal bonds are a little rich right now compared to treasuries, but I'm sure that will change in due time. And think about the risk-return dynamics. You can buy a 5-year treasury or a 5-year muni bond and get the same income as a 10-year treasury or a 10-year muni bond, and only 55% of the duration risk. That's a value. And right now, my partner, Shweta Singh, will tell you exactly where the best value can be found in both markets.
Thank you, Chris, and thank you, everybody, for joining us. I am going to be sharing some slides along with my commentary. So Chris talked about where is the best relative value in the bond market. Okay, let's start with duration, right? Or actually slope of the yield curve. So you're in front of you is a graph for 2s and 10s, which have been inverted from 2019. 2s, all that means is 2-year tenor is higher than the 10-year tenor. Okay, so shorter maturities are more attractive. Now let's move on to the second risk vector in fixed income market, which is credits. Credit spreads are at all-time tights. So there's a dotted line here in my graphic, which shows where the mean long-term averages have been. And the really dotted line shows -1 standard deviation event. The solid bar is a +1 standard deviation event, and yuck, are credit spreads in the -1 standard deviation event. So what we've learned is short is better and no need to reach for yield, right? Okay, so here, this table, what I want you to focus on is real yields. What are real yields? Real yields are the yields that you see quoted minus inflation. How do we measure inflation? We use Fed's favorite inflation measure, core PCE. We are looking at data going back for the first quarter. So I quoted the February 29 core PCE year. All right, so let's focus on how does the different tenor on the treasury curve perform. It's kind of ironic, but it truly mirrors, the tenors mirror the ranking, as in what is attractive. 1-year treasury curve, no surprise, at 493 is the best or the most attractive part of the curve. And what we use as a measure here is it a positive standard deviation event, negative standard deviation event, or is it sitting on the long-term mean? So for example, the 10-year part of the curve is smack on the mean, right? And 1 and 5 look attractive. That's where you're looking at that 70 basis points and 25 basis point numbers. And 30 years, ouch, that hurts, negative 28 basis points. Okay, so, one point I wanted to make on that slide is if you just look at the yields, yeah, 1 year does look attractive, but what do you do if the 1 year goes away, right? The Fed chair came out yesterday, said, sure, rate cuts are in the trajectory. When is the question? So you hold on to that 1 year piece of paper, but you just hold on to that for 1 year. So we've been talking a lot about, hey, beware of the cash trap. Okay, moving on to this slide, what we're talking about is reversion to long-term means. So the column that I'd like for you to pay attention is this new scenario rate. What this really means is where do rates have to go to mimic or mirror the long-term averages. Right now, for example, the 1 year treasury is somewhere 493, and this is again April data, right? It should go to 350, 5 year currently 465, to go back to long-term averages 419. But here's the interesting thing, 10 year, right? This is where it needs the most amount of work in terms of yields rallying, currently 474, has to go back to 521. And remember, I'm only talking right now in terms of yields, but we are total return managers. Let's talk about it in terms of total return. What is total return? Price plus interest, right? And price kind of outweighs the interest piece as we go further down the yield curve. So 1 year, right? All you're getting is your yield. So if you bought 1 year piece of treasury paper, 493, and that's what your total return is. The part of the curve that Chris and I really like is the 5 year part of the curve. Look at what total return does on this part of the curve. So your yield 465, right, plus or minus, now that we are in May. And the price piece, this is the biggest jump here, right? The price appreciation is 2%, giving you a 6.6% handle. 10-year piece, the price appreciates, your price kicks off in terms of your total return, you lose a little. And remember, we said duration is not your friend in the beginning part of the presentation. It really hurts. Being long duration really hurts. Net, really love the 5 year part of the curve, and we think it's an attractive time to buy bonds. Thank you, guys.
Thank you, Shweta and Chris. Really appreciate your comments and thoughts there. We're going to shift over to the global team. Vin, where are you seeing risks and rewards in the global markets?
Yeah, thanks, Michelle. It's interesting. We've had quite a run in the markets and for our portfolios since 2022 and continuing into this year. It was strong results, and people are generally in good spirits, I would say. But there are always risks, and I think there's certainly some dangers out there these days. Here's what I would point to. I think for equity investors, look, you always want to avoid three things in particular: frauds, hype, and unsustainable business models. And right now, we still have a ripe environment for those situations, I would say. In the case of artificial intelligence, AI, that's kind of all the rage these days, and there's elements of truth and legitimate excitement there. But inevitably, there's also pretenders and kind of derivative kind of companies that want to ride along and wrap themselves in this AI kind of wrapper. So that's an area for sure to be careful about. And then we still have this sort of ongoing, rebalancing related to the frenzy of the COVID period, when you had all of these blank check companies, special purpose acquisition companies, and IPOs of companies that were doing well then. But that was sort of a unique period, and many of these companies may not be sustainable. So I'd just be, as a word of caution, there's still a lot of those kinds of traps out there, and we're trying to steer clear of that. However, there's plenty of, with respect to rewards or opportunities, there's plenty of that, and we're happy to be to be involved in some of those areas. I put together a slide. I don't know if we can pull it up, but yeah, regarding the global energy transition. This has been a real important theme for us and City Different within our global research group for the past couple of years. And this is, simultaneously something that has helped us so far in our portfolios, continues to be a big theme. But we think this is a legitimate megatrend and something we're going to be following closely, for the foreseeable future. So, our investors, I'm sure, have noticed in our portfolios and on our blog some companies related to this energy transition theme in the nuclear energy space and the natural gas space, and this trend towards not just more power and more electricity demands in the world, but also cleaner sources of energy. And that all leads to growth in certain areas, and therefore opportunities perhaps for us. There's been a lot of headlines, even just in the last several weeks, even related to this, that we're following closely. You may have noticed in the news, artificial intelligence, which is kind of all the rage, but related to that, it turns out artificial intelligence queries to ChatGPT's queries, for example, they say one request or question to ChatGPT is equivalent to about 10 Google searches, for instance. So a number of companies have come out and said, oh my gosh, this is going to take a lot more energy, a lot more electricity from now on. Amazon, with their AWS, Amazon Web Services segment, they just bought a data center which has dedicated nuclear energy backing it, clean, steady base load power to power their AWS data center. And Mark Zuckerberg at Facebook is also commenting that the future of AI will be pretty directly tied to nuclear energy and new additional sources of energy that will be coming along in the next several years. So we're following that very closely. And then the bottom right corner, I had a little headline there about the U.S. House banning uranium. In the most recent news, as of yesterday, the Senate has also passed this bill, so it will become law. A big deal in the uranium and the nuclear fuel space that we're following closely, and we're pretty enthusiastic about some opportunities we think related to that. For more granularity on this, I actually just did an interview with the Wall Street Transcript. It's posted on our website, where I talk about this theme and some of our specific portfolio positions related to that. And of course, we also published our quarterly portfolio note, which you can find on our website as well.
Great. Thanks so much, Ben. Very interesting. Now let's hear from our domestic equity team. Rob, could you speak to the recent trading activity in the SMID portfolio?
Yes. Thanks, Michelle. So when we think about the SMID portfolio, the SMID strategy, it's high conviction and low turnover. And for most of its history, it's actually been very low turnover. But over the last 9 months, we've had our rotation in our highest conviction ideas. So starting the strategy in mid-2021, 3 of our highest conviction ideas were Assured Guarantee, API Group, and FTI Consulting. Those were all large weights in the portfolio for the last 2.5, 3 years. As they appreciated in value, the risk reward got less attractive, and so they're now smaller weights in the portfolio. Instead of those investments get rotated into some other ideas which have been in the portfolio since its inception, Nomad Foods and AMG, and so those are now big weights in the portfolio. Those are our higher conviction ideas, and so those are the stocks that we're pretty excited about today. Also, over the last 9 months, we've added smaller weights to some new positions within healthcare. Over the last year, there's been a lot of volatility within healthcare stocks with the weight loss drugs and how that could impact healthcare, the healthcare industry and healthcare stocks. And so we bought Stericycle and Sotera Health at starter positions. And then within energy, which we were a zero weight a year ago, with the help of Vin and Zhang, we're now a bit of an overweight in energy with owning Golar LNG and Valaris. So they're both holdings in the global portfolio as well. So a bit of change, a period of less than average turnover to a period of a little bit more above average turnover.
Great. Thank you, Rob. Appreciate it. Now I'd like to give the opportunity to anyone on the webinar to ask any questions they may have of our team. You can submit a question through the Q&A box. Just feel free to type in any questions that you may have. Give a minute here for that. Okay, and we have a question here that just came in. This is for the fixed income team. Is the Fed fund restrictive?
If you were to go back and look over a period of 20 years to see where the average real Fed funds rate would be, you'd have to say yes. Currently, real Fed funds is running about positive 2.53% based on 2.8% core PCE. Over the long-term average, it's been about minus 53 basis points or 0.053%. The long and varied leads that the Fed has referred to have become even longer and more varied as the economy reacts to the COVID era stimulus. And one of the best examples of that is to look at the amount of money in circulation. And we measure that through looking at M2, which measures checking accounts, money, and things like that. M2 over the last 20 years, thinking back to the graph Shweta showed, is 1.8 standard deviations from the long-term mean. Now, I hated statistics in college, but let me just refresh everybody's mind that 70% of the observations are supposed to be between -1 and +1 standard deviation. So a 2 standard deviation event is something to be concerned about. So we have a lot of money in circulation, and what we've found recently is that the velocity of M2 is increasing. Now, before one of the Fed chairmen had said if he had to, he would drop money from helicopters to stimulate the economy. The corollary to that is if people put that money in their basement and didn't use it, it would not stimulate anything. So the fact that M2 is high and we're starting to see an increase in the velocity of M2 is concerning. Look, if you were to ask us what we think is going to happen to the Fed funds rate, Shweta and I would say probably a 60% chance of nothing happening, and that maybe a 30% chance of a cut somewhere down the line, certainly not in 2024, and a 10% chance of a Fed rate hike. So, chairman came out yesterday, we had the Fed meeting, they did nothing. I think the important thing is that many of the pundits you hear on television were saying how dovish Chairman Powell was. Shweta and I don't think he was dovish. We think he was pretty consistent with his message going back to, mid-2023. We're going to wait and see where the data takes us. And so I think that we need a little bit more data. And, if he gets inflation down, great. Then I think they'll move to lower rates.
Thanks, Chris. Here's another question as well. Why is the economy so resilient?
I can take a stab at it as Chris, you unmute. I thought it was really interesting that somebody asked that if the Fed policy was restrictive. Yes, Chris's answer is yes on that. But the other part is the monetary policy, right? The fiscal stimulus that we're still reeling from, and all this money sloshing in the economy with the US budget deficit of 7%, right? The highest it's been in a while, or probably the highest it's been. So there is a lot. So there is the fiscal policy and the monetary policy. Fiscal policy is restrictive. Monetary policy looks very different, and a super tight labor market. We're still yet to see slack in the labor market. The Friday's unemployment number will be big because that'll be a data point that the Fed will be observing and the market will be observing really closely. Chris, do you want to jump in?
Yeah, there's a couple other things to think about. We had a lot of COVID era legislation, the CHIPS Act, Infrastructure Act. That money's starting to hit the economy right now. Okay. The other thing to think about is the great refinancing in COVID. Okay. Both individuals and corporations refinance at extremely low interest rates. Here's one factoid. Half of all 30-year mortgages are now below 3.25%. Think about where a mortgage is right now, 7 to 8%. Who can afford selling their house and having to pay that? So I think that's one of the reasons, a contributing factor as to why we have higher M2 and the economy is proving more resilient and not as sensitive to increases in short-term interest rates.
Thank you. We just had a question come in. Curious on your view of U.S. equity markets relative to its own valuation history and also to other global opportunities. Additionally, curious of your view on the U.S. dollar and how that will impact your holdings.
I can start that, and I don't know if Vin, you wanted to add something. Yeah, within the U.S. market, I see there as being a bit of a bifurcation of there's some stocks that are very exciting, getting higher valuations, and some of those probably are unwarranted. But there's also stocks, some large cap stocks that have really great fundamentals and maybe warrant those valuations. In the less covered smaller cap names within the U.S., there seems to be a lot of attractive discounted stocks that we're finding lots of opportunities.
Yeah, as far as the global perspective goes, it's usually been true for the past 20 years that the U.S. markets have outperformed, and particularly in the last several years as technology has become a bigger and bigger part of our lives and a bigger part of the indices. So that favors the U.S. markets because Google is an American company, and so is Microsoft, and so is Apple. So when you're making that kind of observation, it's important to move from the general to the specific and recognize that from a bottom-up perspective, the U.S. companies are different from other companies, and in many ways, those are superior businesses that should trade at higher valuations and should do better over time. So therefore, I think sort of maybe unfortunately, you can't just look at the statistical data as far as historical performance or valuation metrics and draw many conclusions. So it's true that Europe is cheaper than the European markets are cheaper than the U.S. markets, statistically speaking, but it doesn't follow that that's where the best opportunities are. It really just depends on the bottom up perspective, looking at companies, one at a time, and that's the way we approach things. As far as currency dynamics and currency risk, it's always a consideration, but it's not a top consideration. It's not even in our top three. We're looking from a microeconomic perspective at what we think are the most important drivers, and current currency is something to think about. But if we have big reservations about the currency, that's something we wouldn't be involved in. We're investing in stable, developed countries. Right now, big markets for us are Canada and Norway, and in no case is currency a top consideration.
Great. That is all the questions that we have in our queue right now. So we try to keep these webinars to 30 minutes and stick to that. So I will go ahead and wrap it up. I want to encourage everyone to take a look at our blog page on our website. We have 2 new third-party pieces on there. As Vin had mentioned, we have an interview from the Wall Street Transcript. And then we also have Rob and Chris were featured in Hidden Value Stocks. So if you haven't been on the blog page, there's a lot of content there. Again, I encourage you to take a look at that. And thank you all for joining us today. We'll see you next quarter.